Peter Lynch, one of the history's greatest investors, is teaching us something. For those of you who are unfamiliar with Lynch, he spent 13 years as a manager of Fidelity Investments as a fund manager. For today's video, we will be going to talk about Peter Lynch, 6 mistakes every investor should avoid. We are listening to one of those in-depth interviews today. We hope you appreciate it. Peter Lynch, 6 mistakes every investor makes. Number 1. Learn your natural advantages. People don't use their natural advantages because they are unaware of them. So that's the first bad thing. Number 2. Investing is not a gamble. The second worst thing is believing you're not a good cellist or that you're not a decent ice skater. You won't give it a go. Nevertheless, investors are buying stocks. They are not scared. Simply believe it to be a gamble. As a result, they move forward and make $2 on a stock they have been battling on for a week and a half. Then they sell it and purchase another item. All in all, they generate a lot of commissions over the course of 3 years, but they almost certainly lost money. That is incorrect. Number 3. Earning of a company is 100% correlated to its stock. People may not realize that there is a direct correlation between changes in a company's earnings over a number of years and changes in its stock price. If McDonald's has prospered both financially and operationally, the stock has performed admirably. Oversupply of money is a concern for many individuals. What has happened to the oil price? The president's name has been proposed for the High Court. It's the ozone layer. Nothing can be done. Over the following 10 years, McDonald's earnings increased. Stock will decline. Number 4. No one can predict the market. They play a crucial role. However, you have no way of anticipating what they'll do. The head of the Federal Reserve is Alan Greenspan. He is unable to forecast interest rates. He is astonished by how low long-term insurance premiums are right now because he is unable to forecast what they will be in 1 year, 2 years, or 3 years. How therefore am I to forecast interest rates? I don't know how to forecast the economy. You undoubtedly recall the 1982 recession, which featured a 20% prime rate, 14% unemployment, and 12% inflation. In 1980 or 1981, I don't recall anyone telling that would occur. We had the worst recession since the Great Depression all of a sudden, and the newspaper I didn't read about it. Number 5. If you don't understand what a company does, you should not be investing in it. People have unique advantages, I claim. Let's imagine that as a source of income, you work in the restaurant business. You provide paper goods, kitchen supplies, and construction assistance for eateries. McDonald's was visible. You noticed Chi-Chi. You noticed Chili's. The Cracker Barrel was seen. You noticed a Dunkin' Donuts, fried chicken from Kentucky, Taco Hut. All of these tales included earnings of 40 or 40 times the amount of money invested. You don't have to earn that much money during your life, right? All you had to do was keep an eye on the restaurant business. Individuals work in industries. They are employed by the publishing sector. They work in the chemical field. Why don't they simply stay within the industry? The paper? A decade simply needs a few stocks. How many high-quality stocks do you need in your lifetime? Instead, many are investing in biotechnology stocks while working in the restaurant sector. Chemical industry workers are investing in oil equities. It's completely ridiculous. If you are unfamiliar with a company, if you can't make it clear to a 10-year-old within 2 minutes, own it not. Since when it decreases, let's say your stock falls along with it, do you make any purchases more? Who knows how technology will develop? Megaflops and automatic backplanes are what all these things are. Who knows what these are all 10 years after Walmart's IPO. The past 10 years have passed. It has been in business for 25 years now, 10 years after being public. The stock may have been purchased and profited 50 times as much from it. Imagine you were in town when they entered it. They remarked, "Wow, these prices are amazing. They are doing fantastic. I enjoy the discounts." You looked it over and put some effort in it. People are in general very careful. When purchasing a dishwasher, people conduct some research. They'll invest $10,000 in some stocks while they're on a bus here. So according to your data, Walmart only occupies 10% of the nation. Even there, they aren't saturated. Number 6. Invest more, spend less. They declare that we're going to do more investing and less spending. So why can't they travel to the rest of the nation? There is no disrupting that assertion. You must unquestionably increase your educational spending. You need to put more money into businesses. Less investment is required than simply spending money. I mean, people are urged to spend money today. Imagine that you built an addition to your home. On that, you spend money. Because the interest is tax deductible, you can claim a tax deduction. If you make an investment, take your money and deposit it in a bank. You can pay a hefty amount in taxes. They refer to it as unearned income, which is an exceedingly harsh word. Every time I file my income taxes, I include a line for the amount you made. The money you deposit into the bank is often known as unearned income. Is a derogatory word. However, if you purchase a stock and profit from it, on it you must pay a 28% tax. What did our topic educate you on? Please share your thoughts in the space provided below. Please click the notification bell, give this video a thumbs up, and subscribe to Wealth-ology for more videos like this. Thank you for stopping by to watch. See you in our next video.